Hey everyone, welcome back to the channel. Today, we're diving into an important topic, retirement tax planning. If you're nearing retirement or retired already, understanding how taxes will impact your income is crucial. So if you want to keep more of your hard-earned money and avoid unnecessary tax bills, stick around because we've got some essential strategies to share. Before we dive in, let me know in the comments, what's your biggest tax concern in retirement? I would love to answer your questions in a future video. Retirement changes the way you pay taxes, and these are some of the most common questions we get from retirees. How will my taxes change in retirement? Will my Social Security benefits be taxable? How will our taxes be impacted if my spouse or I pass away? How can I reduce my required minimum distributions or RMDs? How can I give money to charity in a tax-efficient way in retirement? We'll provide answers to each of these questions and show you strategies to keep your tax bill as low as possible. So during your working years, taxes are pretty straightforward. Most of your income comes from a paycheck and taxes are withheld. But in retirement, things get more complicated because you're pulling money from sources that are taxed differently. So let's discuss the most common income sources and how they are taxed. Roth IRA and Roth 401k distributions are tax-free if you follow the rules. Traditional IRA, 401k, pension, and annuity income is taxed as ordinary income. Short-term capital gains and non-qualified dividends are taxed as ordinary income as well. Social Security benefits may be taxable, depending on your income. Long-term capital gains and qualified dividends are taxed at between 0 to 20%, depending on your bracket. So let's walk through an example to show why it is so important to understand how each income source is taxed. Imagine you're a retiree with $65,000 of income from the following sources: $30,000 from a pension, $20,000 in Social Security, and $15,000 from investment dividends. In this example, your tax bill for the year will be $3,362. Now imagine you are the same retiree but with $40,000 in Social Security and $25,000 in Roth IRA distributions. In this case, your tax bill for the year will be $0. As you can see, not all income is created equal. A common mistake retirees make is assuming they should spend down taxable accounts first, delay Social Security, and wait for RMDs before touching retirement accounts. But that might not be the most tax-efficient approach. Instead, a strategic mix of withdrawals, like early withdrawals from traditional IRAs, conversion to a Roth, and management of capital gains can smooth out tax liability and save money in the long run. Let's look at an example. Let's say you're 62 and recently retired. Instead of waiting until 73 for RMDs, you take small withdrawals from your IRA now, keeping yourself in a lower tax bracket. This reduces your future RMDs and saves thousands in taxes over time. So let's discuss Social Security taxation next. Social Security benefits may be taxed federally depending on your other income. Most states, including Illinois, where we are based, do not tax Social Security benefits. Whether your Social Security benefits are federally taxable depends on something called provisional income. Now, provisional income is equal to your adjusted gross income, or AGI, plus non-taxable interests such as municipal bonds, and 50% of Social Security benefits. Depending on where your provisional income falls, up to 85% of your Social Security benefits could be taxed. So here's a quick breakdown. Single filers with provisional income under $25,000 or married filing jointly with provisional income under $32,000 do not pay federal tax on their Social Security benefits. Once your provisional income exceeds this threshold, a portion of your Social Security benefits will be treated as taxable. Now, let's look at an example to help clarify how this works. Both couples need $67,000 a year for living expenses. The only difference between the two couples is that couple 1 is taking $25,000 from a traditional IRA and couple 2 is taking $25,000 from a Roth IRA instead. This relatively simple adjustment creates a significant difference in how their Social Security benefits will be taxed. The provisional income for couple 1 will be $56,000 and for couple 2, $31,000 since the Roth IRA withdrawals are not included. If we assume a 12% federal tax bracket, this difference will save couple 2 $2,240 in federal taxes every single year. One thing many retirees overlook is what happens to taxes when one spouse passes away. The surviving spouse often moves to a higher tax bracket while losing part of their income. Medicare premiums may also go up due to income thresholds. For example, a couple filing jointly with $132,000 in income pays a lower tax rate than a surviving spouse with $108,000 in income because single tax brackets are less favorable. In addition, the surviving spouse would pay an extra $74 monthly for Medicare Part B premiums. Now, by planning ahead, you can help avoid this tax burden. One way to do this is to lower your future required minimum distributions, or RMDs. RMDs start at age 73 or 75 for some individuals depending on birth year, and they can push you into a higher tax bracket. Here are 3 ways to reduce them. Number 1 is Roth conversions. Moving money from a traditional IRA to a Roth IRA reduces future RMDs. Number 2 is early IRA withdrawals. Taking some money out before RMDs begin can smooth out taxable income. Number 3 is qualified charitable distributions, or QCDs. If you donate from your IRA directly to charity, it satisfies your RMD without increasing taxable income. Now, let's dive into each of these further, starting with Roth conversions. As you can see, there are 4 main reasons someone may choose to complete a Roth conversion. These include reasons that affect you, such as tax-free growth, reduction of Social Security taxation, and lower RMDs, to items that affect your beneficiaries, such as tax-free inheritance or achieving lower tax brackets for the surviving spouse. Without a Roth conversion strategy, many retirees will experience increasing RMDs as they age. This is because RMDs are calculated by taking your IRA balance and dividing by your life expectancy according to IRS tables. Now, for many retirees, their IRA balances continue to climb throughout retirement, and their life expectancy drops, so the RMD amount increases. The distributions from the IRA are fully taxable for you or your heirs, resulting in a significant tax bill over your lifetime. By implementing a Roth conversion strategy, we can lower or eliminate future RMDs, experience significant tax-free growth, and avoid other tax headaches in retirement, such as Medicare premium surcharges, also known as IRMA. You can see from this chart that a Roth conversion strategy requires a few years of tax pain to receive the benefits over the remainder of your lifetime and the benefits to your heirs. Now, we discussed the benefits of a Roth conversion, but let's talk about when Roth conversions don't make sense. Roth conversions don't make sense if you will be in a lower tax bracket in the future, you may need the funds in 5 years or less, you have no heirs, you plan to leave your IRA to charity upon death, you currently qualify for a senior freeze property tax exemption dependent on your income remaining below a specific threshold, or you are currently in a year when your Social Security benefits are not taxable. Now, let's discuss early IRA withdrawals as a strategy to lower RMDs. It is very common for individuals to withdraw money from their checking, savings, CDs, or brokerage accounts before touching their IRAs. This is not always the best strategy. If we can withdraw money from your IRA and only pay 12% federal tax on the withdrawals, this may be a better solution than waiting until later and paying 22% or more on those same withdrawals. One additional strategy used to lower RMDs is a qualified charitable distribution, or QCD. Let's discuss this strategy along with another charitable giving strategy that can be used in retirement to give tax efficiently to charity. If you're 70 and a half or older, you can donate up to $108,000 per year directly from your IRA to a qualified charity. It counts as your RMD, but isn't taxed as income. This is by far my favorite strategy for giving money to charity in cases where an individual does not need their full RMD to pay their bills and is charitably inclined. The reason I love this strategy so much is because the donation is treated as tax-free even if you don't itemize your deductions. Let me show you how powerful this can be. In our example, we have a client who wants to give $40,000 to a charity. The money is currently in their IRA, so they essentially have 2 options. Option 1 is to withdraw the money, pay taxes, and then give the remaining amount to charity. Option 2 is to execute a QCD and give the full $40,000 to the charity without paying taxes on the distribution. Option 2 results in almost a $12,000 tax savings, and the charity receives the full $40,000. So here's another great way to give to charity if your money is in a brokerage account instead of an IRA. This strategy involves donating appreciated securities. Instead of selling stocks and paying capital gains tax, donate them directly to charity. You will avoid capital gains tax and still get a deduction. In our example, we have a client who wants to give $50,000 to a charity. The money is in their brokerage account and is invested in a stock that has grown $30,000 since buying it. If they sell the investment, pay the capital gains tax owed, and donate the remainder to charity, they will pay $4,500 in taxes and the charity will receive $45,500. If instead they donate the shares directly to the charity before selling, they don't pay any capital gains taxes and the charity receives the entire $50,000. Now, remember that all strategies discussed today are based on the current tax laws, and as we all know, tax laws change. Ensure you are working with a wealth management firm that is on top of these changes and can adjust your strategy as needed. Retirement tax planning is complex, but making smart decisions now can save you thousands over your lifetime. If you found this video helpful, hit that like button, subscribe for more retirement and tax planning tips, and don't forget to drop your questions in the comments below. Once again, I'm Mike Heatwall, founder and CEO of the Dalla Group. If you are interested in seeing how we help our clients, visit us at www.thedallagroup.com. Give us a call or schedule a time to connect with one of our wealth advisors. We would love to hear from you.